managerial accounting, planning and control, variable manufacturing overhead variances. All right, we looked at materials, we've looked at labor. Now we need to take a look at the variable manufacturing overhead variances. Now, the variable manufacturing overhead variances are a spending variance and an efficiency variance. The spending variance compares actual variable manufacturing overhead costs with the actual hours worked times the standard rate. Now, in this particular problem, overhead is applied based on direct labor hours. So we'll be using the actual direct labor hours in calculating this variance. But be careful, this is a variable manufacturing overhead variance. So be sure to pull the rate, the standard rate, for variable manufacturing overhead, not for labor. We've already done that variance. Also notice the formula is a little bit different in that we're not multiplying something to get this number. Usually with variable overhead, we are simply given that amount in total. So once again, let's look back at our data and see what we've got. First of all, the standards. Our standard variable overhead rate was $2 per direct labor hour. And remember, the standard for direct labor hours is 0.75. We'll use that in the efficiency variance. Now let's look at the actual cost information. Actual variable manufacturing overhead was a total of $48,300. So that's the amount that we're going to use in calculating our variable manufacturing overhead spending variance. Now let's just plug it in and do the math. The actual variable manufacturing overhead cost, as we just saw, was $48,300. And then we'll compare that to what overhead cost should have been based on the standard for the actual hours worked. So 23,000 actual direct labor hours times $2 per hour, the variable overhead rate. So let's see, 23 times 2 is 46,000. So we've got 48,300 minus 46,000. So our spending variance for variable overhead is $2,300. And that's going to be an unfavorable variance because we spent $2,300 more, actually, than the standard says we should have for this level of activity. So an unfavorable spending variance. Now, like with the selling and administrative expenses on the flexible budget performance report, we need to look at each element of variable overhead to really understand what caused this variance. So we'd look at things like the lubricants, the cost of oil for the machines, the electricity, and those sorts of things to identify exactly what did we spend more for than the standard called for. And usually in textbook world, that level of detail we don't get into. Just be aware it needs further investigation. All we can say at this point is that we spent more for the variable overhead resources than the standard called for at this level of activity. Now, the next thing we're going to look at is the variable overhead efficiency variance.